You've probably heard people say, stocks are safe, and crypto is the future. But the truth is they're completely different. If you want to invest smart, you need to understand what makes each one unique. In this video, I'm going to break down stocks vs crypto, explain how each one works, and show you how to evaluate them like a pro. What stocks actually are: stocks represent ownership in a company. When you buy a share, you own a small piece of that company. That means if the company makes money, the stock price usually goes up. And if the company loses money, the stock price usually goes down. So stocks are tied to real businesses that have real revenue, real assets, and real financial statements. Stocks are regulated, and companies must report their earnings and financial health every quarter. How the stock market works: the stock market is a centralized system where stocks are bought and sold on exchanges like the NYSE or NASDAQ. Companies issue shares through an IPO, and then investors trade those shares on the market. Stock prices are influenced by things like company performance, industry trends, macroeconomic conditions, and investor sentiment. That means when the economy is strong, stocks usually go up. And when the economy is weak, stocks often drop. Reading financial statements: to understand stocks, you need to understand financial statements. The income statement shows revenue, expenses, and profit. The balance sheet shows assets, liabilities, and equity. And the cash flow statement shows how cash moves in and out of the company. When investors analyze stocks, they use these statements to figure out if the company is healthy, growing, and profitable. Fundamental vs technical analysis. Fundamental analysis means evaluating the company's financials, business model, growth potential, and competitive advantage. Technical analysis means reading charts, patterns, and indicators to predict price movement. Fundamental investors care about long-term value. Technical traders care about short-term price action. Building a stock portfolio. A portfolio is a mix of different investments. You build a portfolio to diversify risk. A good portfolio usually includes a mix of growth stocks, value stocks, dividend stocks, and sometimes bonds. The goal is to reduce risk while still achieving long-term growth. Finding undervalued stocks. Undervalued stocks are those trading for less than their real value. Investors look for low PE ratios, strong cash flow, and strong fundamentals. The goal is to buy before the market realizes the stock is worth more. Growth stocks vs value stocks. Growth stocks are companies expected to grow fast. They often reinvest profits instead of paying dividends. Value stocks are priced below their intrinsic value. They may grow slower, but they often pay dividends and are more stable. Both can be profitable, but they require different strategies. Market cycles and macro trends. The stock market moves in cycles: expansion, peak, contraction, and recovery. Macro trends like interest rates, inflation, and unemployment influence stock prices. For example, when interest rates rise, borrowing gets more expensive and companies can slow down growth. What crypto actually is: crypto is digital assets built on blockchain technology. Instead of owning a piece of a company, you own a token that represents value, utility, or access to a network. Crypto is not tied to earnings or cash flow like stock. It's often driven by adoption, utility, and speculation. How blockchain works: blockchain is a decentralized ledger that records transactions across a network of computers. Each block is a group of transactions, and once it's added to the chain, it can't be changed. Blockchain is secure because it is decentralized and transparent, and it eliminates the need for a middleman like a bank. What drives crypto prices? Crypto prices are driven by supply and demand, adoption, hype cycles, and market sentiment. Crypto is also extremely sensitive to news, regulation, and major events. A single tweet or announcement can cause huge price swings. That's why crypto is more volatile than stocks. How to evaluate crypto projects? Evaluating crypto projects is different from stocks. You need to look at the team, the use case, adoption, tokenomics, and real-world utility. Ask questions like: what problem does this project solve? Is it being used, or is it just hype? Does the token have real value? DeFi basics. DeFi stands for decentralized finance. It allows people to lend, borrow, and trade without banks. It uses smart contracts to automate transactions. DeFi can be powerful, but it comes with high risk because smart contracts can be exploited. NFTs and tokenomics. NFTs are unique digital assets. They represent ownership of digital items like art, music, or game assets. Tokenomics is how a token is designed. It includes supply, inflation, and utility. Tokenomics determines whether a token is scarce or inflationary and impacts long-term value. Trading strategies in crypto. Crypto trading is often more aggressive because of volatility. Common strategies include swing trading, day trading, trend following, and long-term holding. A common method is dollar cost averaging, which reduces risk by buying at regular intervals. Risk management. Crypto risk management is critical in crypto. Never invest more than you can afford to lose. Use position sizing and stop losses. Crypto can swing 20% in a single day, so managing risk is the difference between surviving and getting wiped out. Avoiding scams and rug pulls. Crypto is full of scams. Rug pulls happen when developers abandon a project and steal the funds. To avoid scams, always research the team, check for audits, and avoid projects that promise unrealistic returns. A legit project has real adoption, transparency, and a clear roadmap. So here's the bottom line. Stocks are ownership in real companies with real earnings and real value. They are regulated and generally safer for long-term investing. Crypto is digital assets that can offer huge upside but also massive risk. Crypto is driven by adoption and sentiment, and it's much more volatile. If you want stability and long-term wealth building, stocks are usually the better path. If you want high risk and high reward, crypto can be powerful, but you must be careful and do your research. If you found this helpful, drop a like, hit subscribe, and comment below which one you prefer, stocks or crypto. Also tell me what topic you want me to break down next.